Hello, and welcome to another episode of Getting Your Shit Together. Today, we are diving into a hot topic: Canada's tariff war with the US. This economic showdown has sparked concerns across Canada. But what does it really mean for your finances, your real estate investments, inflation, and mortgage rates? Well, more importantly, what can you do to stay financially secure? Let's break it all down. Let's set the stage. The US, a long-standing partner and ally, has threatened to impose hefty tariffs on Canadian goods. 25% on most goods, 10% on key resources like oil and electricity. And it was supposed to be effective from the 3rd of February, but we got a 30-day reprieve. In response to the earlier executive order, Canada also retaliated with its own tariffs. This potential tit for tat can escalate quickly, affecting trade, jobs, and ultimately household finances unless cooler and, frankly, more sensible heads can prevail. Economic experts are divided. Some see this as a short term political move, while others worry about the long term consequences. Historically, these kinds of disputes have gotten resolved when the herd starts to get real. But that does not mean that we get spared from short term turbulence. So let's talk about what this means for your wallet. Canada imports a lot of goods from the US, and so import cost will rise in the event of tariffs, which in turn could push inflation higher. And as you know, the Bank of Canada may have to adjust its policies accordingly, as inflation control is its only mandate. If inflation climbs, the much expected rate cuts might get delayed, or we may even see rate increases. Trade slowdowns could lead to layoffs, affecting job security for many Canadians. The Canadian government will, of course, be forced to provide economic aid to suffering businesses and individuals. Banks might need to step in with special programs for borrowers, and this could mean a repeat of what we witnessed during COVID. And we all know how that played out. And in many cases, it is still playing out. Ultimately, it won't be good. While some sectors might get hit harder, others could benefit. Domestic manufacturing and non US trade partnerships could see growth opportunities. So, how does this all impact homeowners and buyers? Well, if inflation rises, mortgage rates could stay elevated longer than anticipated. Economic uncertainty might cool the housing market and reduce market activity, or the anticipated uptick in market activity could get further delayed. If the economy slows down significantly, we could see policy interventions like the mortgage relief programs, which were rolled out during COVID. There are multiple cross currents at play here. And so the outcome in terms of affordability, property prices, interest rates, etc., could rise or fall depending on which forces are stronger. There are no guaranteed short term outcomes. But what do we know based on our long history of such tumultuous events? And it is this: real estate remains a long term game. And while there will be pains in the short term, it all boils down to your ability. I'll repeat, your ability to withstand short term turbulence and pain. If you're financially strong, you will survive and may even come out ahead, as many did during COVID. So focus on affordability, staying power, and avoid speculation. Now let's talk about something just as important: your mindset during all this turmoil. It's very easy to get caught up in doom and gloom headlines, but history has shown that these economic flare ups tend to be more bluster than bite. I'll repeat, these economic flare ups tend to be more bluster than bite. The best thing you can do is to stay the course with your financial plans. Like, avoid making rash decisions. Do not sell assets, be it investments, real estate, your home, your rental properties, in a panic, or drastically change your investment strategy. Keep your financial foundation strong. Focus on an emergency fund, have manageable debt levels, and keep focused on long-term investments rather than short-term speculative bets. Remember, governments and the central banks have tools to manage economic disruptions. If things go really bad, expect policy responses to cushion the impact. But again, do not solely rely on those measures for your own financial safety. And this is what you can do right now. Stay informed, but do not obsess over headlines. Take a step back and look at the bigger picture. If you're concerned about rising rates, explore refinancing your mortgage to lower your interest cost, or maybe even get lower monthly payment. Move into fixed rate if you are on a variable rate currently, and maybe, if possible, even hedge your borrowings. If job uncertainty is a concern, consider upskilling or maybe even creating additional income streams. It seems like everybody needs one these days. Markets fluctuate, policies change, but the long-term financial discipline will always be to reactionary decisions. So in closing, this tariff war will have ripples, but panic is not the answer. Keeping your financial house in order, taking a long-term approach, and do not let short-term news cycles dictate your major life decisions. Okay, now let's change topics and dive into two of the most powerful registered investment accounts available to most Canadians, namely the RRSP, or the Registered Retirement Savings Plan, and the TFSA, which is tax-free savings account. These accounts can be game changers when it comes to building long-term wealth and reducing your tax burden. But there is often confusion about how they work, when to use them, and how taxes come into play. Now, before we dig in, let me throw out a quick disclaimer. I'm not an investment advisor, and nothing in this episode should be taken as personalized financial advice. This is just general information to help you understand your options, and always consult with a financial advisor before making any investment decisions. If you are a do-it-yourself investor, make sure to educate yourselves before putting your money at risk and take advantage of some great free resources available, details to be shared. So let's start with RRSP. The RRSP was introduced by the government and to encourage Canadians to save for retirement by offering taxed deferred growth. It's not tax avoidance, it's tax deferred growth. So here's how it works. Contributions to an RRSP are tax deductible, meaning they reduce your taxable income for the year you contribute. Investments grow tax-free while they stay inside the account. When you withdraw your money outside of the outside RRSP, it is taxed as income based on your marginal tax rate at the time of withdrawal. The main benefit of an RRSP is tax deferral, as mentioned before. The idea is that you contribute when you are in a higher tax bracket, and typically that is the case during your working years, and withdraw during retirement when you are in a lower tax bracket. That way, you pay lesser tax overall. Each year, you can contribute up to 18% of your previous year's income, up to a maximum amount set by the government. I'll repeat, it is 18% of the previous year's income and not the current year's. For 2025, the maximum contribution you can make is 32,490. That means any Canadian with a taxable income of about 180,500 in the previous year can utilize the full limit. And so I would say it's a pretty generous limit. If you're unable to use your available limit in a given year, the unused contribution room carries forward. So if you haven't maxed out your RRSP in previous years, you can still use that space later on. The contribution deadline for a tax deduction in a given year is typically 60 days into the following year. So if you're looking at taxes for 2024, you have until the end of February or this month to make up your contributions. Now, while RRSPs are great for retirement savings, they do come with restrictions on withdrawals. If you take money out before retirement, you will owe taxes on that amount, and your financial institution will hold a portion of it right away. So you will not get the full benefit of the withdrawal. This is just an upfront payment as well. When you file your taxes, you might owe more or get some of it back depending on your total income. So the lesson here is do not over contribute. Balance this out with other investments, which can be more accessible to cover any planned expenses or an emergency. And an important note about losses. Any losses on an investment within the RRSP cannot be claimed as a tax loss. Also, that contribution room is lost forever. So keep your riskier investments outside the RRSP. Okay, let's switch to TFSA or the tax-free savings account. Despite the name, it is not just a savings account. It's an investment account wherein your money grows tax-free and you won't owe taxes on when you withdraw or on any gains that you have in that account. So this is how it works. Contributions are not tax deductible. So that means you do not get a tax break like with an RRSP. You are always using your after-tax income for contributions. But investments inside the TFSA go tax-free. You can withdraw the money at any time, and you won't pay taxes on those withdrawals. The big advantage of an TFSA is the flexibility. It is great for both short-term and long-term savings because there is no penalty for taking money out when you need it. Each year, the government sets a contribution limit for the TFSAs. In 2025, that limit is $7,000 and it is always indexed to inflation. If you were at least 18 in 2009, when the TFSAs were introduced, and you have never contributed, your total room for contribution is 102,000. The key to remember is that when you withdraw from a TFSA, you get that contribution room back, but not until the following year. And if you ever over contribute, you will be hit with a 1% penalty per month on the excess amount. So be careful and watch out for your limits. Now, how about losses in a TFSA? If you incur a loss in your TFSA, one, you do not regain the lost contribution room. That's gone forever. B, you cannot claim a capital loss for tax purposes. It's tempting to place high-risk investments in a TFSA to avoid taxes on potentially substantial gains, but proceed with caution. While the potential rewards may be attractive, the downsides, beyond just losing your original investment, can be significant. One thing that people do not realize is that withholding taxes apply to US dividends inside both an RRSP and a TFSA. Now, in the case of an RRSP, the US dividends are exempt from withholding tax if you hold US stocks or ETFs directly. But in a TFSA, the US dividends are subject to a 15% withholding tax since you do not get a tax credit for it. It will eat into your returns. So, depending on your brokerage, you may or may not be even aware of this withholding tax getting deducted. But that's something to watch out for. Or that means if you're holding US dividend stocks, dividend paying stocks, an RRSP is a better place for them. While a TFSA is great for Canadian stocks, ETFs, and other growth focused investments. So, which account is better? Well, as always, it depends on your goals and the tax situation. If you are in a high income bracket and want a tax break now, then maximize your contribution to the RRSP. If you want more flexibility and tax free withdrawals, go with the TFSA. But if you can, maxing out both is the best strategy. So, to wrap up, both RRSP and TFSA are powerful tools that can help Canadians build wealth. Understanding how they work and how to use them strategically can make a huge difference in your financial future. If you are a do-it-yourself investor and are looking for more information, check out resources like My Own Advisor or the Canadian Couch Potato or Talkan. These are all great resources for learning more about investing. And as always, if you're unsure about anything, talk to a financial professional. That's it for today's episode. If you found this helpful, share it with a friend.